Hey, what's up guys? John here. Landlords nationwide are in massive panic mode about what's going on that no one's talking about, which is massive rent declines. Rents are coming down in dramatic fashion in some of the hottest markets. I'm talking 20% annual rent decline in Austin. Some of these markets are the hottest places where people wanted to move and leave San Francisco and these other markets, and everyone was it was a mania to invest in these hot areas. Now, everything's changing. The entire game is changing. And what we're going to likely see is a lot of landlords lose their shirt. They're going to get absolutely devastated and crushed by what's going on right now with mortgage rates. Look at the facts. Look at what's going on. I believe you're going to see a clear picture and a clear opportunity for you as a new investor or a seasoned investor to be able to step out there and pick up some incredible deals based on the future reality of what we're stepping into. Please hit the like button. Hit the like button. YouTube will share this content. And also, today's video is sponsored by GreatCreditFast.com. That's GreatCreditFast.com. If you want to fix your credit to position yourself for the greatest wealth transfer of all time, we'd love to give you a free consultation. Look at this. So, more than $2.9 trillion in commercial mortgages, half of $2.9 trillion in commercial mortgages need to be refied over the next year and a half. That's a big number. Morgan Stanley said it's going to be worse than the Great Financial Crisis. Right? Look at how this plays out. Austin, rents down 20.76%. New Orleans, down 20%. Vegas, down almost 11%, 10.57%. Houston, 8%. Seattle, 8%. Cincinnati, 6%. Phoenix, 6%. Birmingham, 6%. Memphis, 4.8%. Oklahoma, 4.4%. And if you thought that landlords, they're okay with this, that they're not paying attention to it, 48% of landlords surveyed, roughly half of all landlords, say that they're not going to increase rent because they don't want to take a chance of turnover. And the reason for that is because they know that if a renter went out in the marketplace right now and was looking for an apartment, they would probably be able to find a better deal. They'd probably be able to find a situation that might be more comparable or maybe in a better area. They don't want to take the risk. For example, my office in South Florida right now, I just relocated from one office to another and saved 40%. 40%. The reason for it is the market's changing. Landlords know this. Landlords are aware of this. And as this is going on, we are seeing, look at San Francisco. Rents dropped 3.7%. Now, people will say that's not that big of a number. Look at the direction of San Francisco. Look at the crime. Look at some of these big box stores that are leaving. Look at the opportunities that are fading away. Look at the crazy, insane policies that are happening in San Francisco. A lot of markets are changing and getting restructured. And I believe what we're going to start to see during that change is wealth transfer in large levels. Places like LA, we're going to start seeing big changes because these cities are radical. They're pushing forward radical policies, and a lot of people are moving around because of it. Now, look at what's going on if you were to be an investor over the last couple of years. Now, granted, nearly everyone was an investor, whether it be an Airbnb or house flipping, house hacking, commercial real estate. But look at how this plays out, because I don't think many people that are in real estate understand how this works. So I'm going to break it down simply so people can see what's really going on. So a $2 million purchase price of a multifamily property. Let's say that this $2 million deal has 8 apartments, right? 8 apartments, and each apartment is currently renting for $1,750 each. The gross monthly income would be $14,000. So you just take 8 times $1,750 will give you $14,000 a month. The annual gross income would be $168,000. So you just take the monthly gross income times 12 months in a year will give you $168,000. The net income is roughly 65%. It all depends on the building. It depends on the age of the building, condition of the building, but it's usually between 30 and 40%. So of overall income goes towards these expenses, such as in taxes, insurance, repairs, evictions, vacancies, stuff like that. So we'll just say 35% to keep it in the middle. So of the $168,000, you'd be left with about $109,000 in annual net income. If you were to pay all cash for the building, you'd make about $109,000 on this deal, right? Now the monthly income is $9,100 a month. But investors, they don't pay all cash. Most investors, what they're doing is they are borrowing money. They're borrowing as much as they can. Probably 70% of the purchase price they will borrow. So on this $2 million deal, they might borrow $1.4 million and put $600,000 in cash as a down payment. But based on the lower interest rates that we were seeing before, about 3.5%, 4%, the monthly payment would be about $5,902 a month, right? Which would allow the investor to get $3,229 a month. But they'd also get principal paydowns and some tax benefits. There'd be a lot of benefits with this. But a lot of investors didn't run out there saying, you know what, that's my game plan to try to make a few grand a month after investing $600,000. What they would want to do is they'd want to buy the building, they'd want to invest money to fix up the units, increase the rents. As the rents climbed, the asset value would climb as well. And so in a really good situation, the investor could go in there in 6 months or a year, fix up the property, increase the value, go back to the bank, and showed them the numbers, the new deal of how this building is cash flowing now, and then they would send out an appraiser. They would say, okay, the building is worth this now, and the investor will be able to get all their money out. Hold the building, the renters will pay down the debt, and they would ride tax benefits and cash flow and rent growth into the sunset, right? That was basically the game plan. But look at how this is changing now. At a 6.5% interest rate, that $1.4 million loan is $8,900 a month. And remember, this building is making $9,100. But let's not forget that rents are dropping. So if rents are dropping 7% in many of those hot areas, some of them are a lot more, but we'll just be conservative here. 7%, right? Across 8 doors, it's $122.50 per month per door, which is $980 a month in lost revenue. That's a big number, right? That is a big number. And so how does this kind of play out? Well, when they have to refinance these loans, the bank is going to do the same thing. They're going to look at the income of the building. They're going to look at the cash flow. They're going to look at the environment. They're going to look at comps. They're going to see what's going on in the market and then give a valuation on that building. And in many cases, landlords are now going to have to bring forward more money just to keep the deal, to hold on to the deal. And what landlord, what investor that's losing money hand over fist is going to bring forward a lot more money to try to hold on to their building? Not many, right? Not many. And this situation looks like rents are going to continue to fall in dramatic fashion. Here's why I believe this, and here's kind of how this is working out. So look at Los Angeles, for example, recorded the biggest year-over-year, year-to-date market decline of 6.3% in May, followed by Phoenix and Houston. But you start to look at this. On a $8,900 mortgage payment, that at 6.5%, look at it even at 7%. They're down $200 a month. $200 a month, not factoring in for rent declines. But we're going to see a ton of housing hit the market for rent. There's going to be so many more options for tenants in the years to come that landlords that thought they had this huge advantage with a housing shortage are going to get completely rug pulled. So look, privately owned housing stats starts in May, where it's seasonally adjusted in annual rate of $1.631 million. This is a 21.7% or 14.8% above the revised April estimate of $1.34 million and 5.7%, 10.8% above the May 2022 rate of $1.543 million. Single-family housing starts in May were at a rate of $997,000. This is 18.5% above the revised April figure. The May rate for units in buildings with 5 or more was $624,000. Private owned housing completions in May were seasonally adjusted annual rate of 1.518. This is 9.5% or 12.3% above the revised April estimate of 1.386 and 5% above the May 2022 rate of 1.446. Single family housing completions in May were at a rate of 1,009,000. This is 3.9%. Like, you get the idea. There's so much more inventory that's going to be hitting the market. And as this is all kind of playing out, you look at where the everyday consumer is. And this is where I think that the big problem is that nobody's talking about. You have 40% of all U.S. mortgages were originated between 2020 and 2021, right? 40%. Bloomberg, right? Sorry, Fed, most U.S. mortgage rates were locked in. That's going to be a problem for landlords, and here's why. The average down payment for first-time buyers, 6% for the first home, while a repeat buyer put down 13%, right? So when you're kind of like playing this out and you're looking at the average home was $440,000, right? $440,000 in America, and so let's say that they put 6% down as a first-time home buyer, and they got a 3% mortgage, right? $1,729 a month. right? Where are you going to rent an apartment? What city are you going to rent an apartment, or which area are you going to rent an apartment for $1,700 a month? It's pretty hard now because national average rent's probably around $2,000. And so when you're looking at that, you're like, okay, you have property owners, tons of them, like millions and millions and millions of property owners that have these 2.5, 2.8, 3% mortgages. And this is at 3%. Some of them have 2.5. So when you're looking at that, these property owners, if they lose their job, if they step into hardship, what are they going to do? If they don't have equity in their properties, they're going to sell, because a lot of them don't now, because mortgage rates now are 7%. So you're looking at $2,728 a month. So you're going to have to make, for that situation, $100,000 a year to be able to qualify. You're going to have to make roughly 3x your monthly payment. So give or take $8-9 a month. That's for the median home in America. So you start to look at how this kind of plays out, even for a second home. So you're putting down, let's say, 13%. So you're financing ballpark. You put down, $40,000. You're still, right now at today's mortgage rates, you're $2,595, right? At a 3%, you're $1,644. So what are you going to see? You're going to see so much inventory hit the market, not just from all these new properties that are being built, but all these homeowners that are stepping into financial hardship. They're going to start renting out rooms. They're going to start doing whatever they have to do to bring in money when things start to hit the fan. Right now, people, I think, don't see what's actually on the horizon, but this is what's going to happen. Look at how inflation is going to start to impact people. And remember, student loans, they haven't started yet. September, October, you're going to start seeing more expenses being piled on the everyday American. So how much does inflation cost in Nevadians? $800 a month. The pain isn't going away. Inflation cost households an extra $10,000. You start to add this stuff up. What does this mean? You're going to start to see more defaults across multifamily, because people are going to feed themselves before they feed their landlord. People are going to try to feed themselves, and then they're going to try to pay their mortgage. They're going to try to do whatever they have to do, but they're going to worry about survival first, and that's going to be a problem for a lot of these landlords. Real average weekly earnings decreased 0.1% month over month, and homeowners who held into 3% mortgage rate are becoming accidental landlords, like I've been kind of covering here. But look at this. The refinancing boom helped households' finance positions. New York Fed research noted that during the pandemic, 14 million mortgages were refied. 14 million. And what do people do when they refi? Most of the time, they'll go buy another rental property. They'll go make an investment, or they'll pay down debt. But what happens if that first investment, you pulled that money out, and then you bought an investment, and then that investment went south? Maybe you put it in the stock market, which I know people personally that have done that, where they pulled their money out and they put it in the stock market's crashing, now they're panicking. Well, we're going to start to see a lot of people seeing some scary things, and they're going to start to respond accordingly by either renting out their homes if they don't have equity, or doing what they have to do to try to make it. But allowing $430 billion in home equity to be extracted through cash out refis. About 64% of those actions were homeowners refinancing to a lower rate, which allowed an average payment reduction of $220 a month. The mortgage refinancing boom is over, but the impact will be seen for decades to come. And this is Household Public Policy Research. New York Fed said in a statement, as a result of significant equity drawdowns, mortgage borrowers reduced the annual payments tens of billions, providing additional funding. This is what I'm saying. Additional funding or spending in other areas. Now, auto loan delinquencies are starting to skyrocket. Auto loan delinquencies for younger borrowers, those under 40, surpassed pre-pandemic levels, with inflation driving up car prices. The average car payment is hovering around $700 a month. For some people, car payments might be rivaling rent payment, but then again, rent has gone up so much that I think it is a cumulative effect. Now, the moment people I believe will pay their car first before they pay the landlord, because if they pay the landlord first, they don't have a car, and if they don't have a car, they don't have income, and then if they don't have income, there goes everything. So I think we're going to see very, very, very big changes coming for multifamily, for the housing market, for real estate as a whole. Now, I'm not bearish on multifamily or real estate as a whole. I think it's an incredible investment. You just have to understand it. You have to see the trends. I think if you're going to buy real estate right now, you're going to buy multifamily, you need to do so and be extremely conservative based on what's actually happening. I would underwrite massive rent declines in the near future. And if you could buy a deal where rents are declining 20% from here or 25% from here, and it still makes a lot of sense, You talk to building and safety, you see what the new building upgrades might be in your area in the coming few years, because there's these new environmental upgrades that are going to be coming to most areas in America. Look at New York, Miami, a lot of markets. I actually did a podcast with someone I'm going to be releasing in the next week or so that works for a company that is that's getting funding from the government. They're borrowing money between 0 and 1%, 0 and 1%, and then they're lending it out to these property owners at 5 to 6% to do these upgrades. So you just have to pay attention to this. Pay attention to where rents are likely headed. Pay attention to real wages, where wages are likely headed, which are going to be south. We're going to start to see some big changes in the economy. If you're paying attention to all of these things, and you're the only one doing it, and everyone around you is just betting that everything, interest rates are going to go back to 3%, at the end of the day, you're going to win. That's what's going to happen. You're going to win. The conservative investor that is built for the marathon is always going to beat the one that is just trying to run the sprint. Drop your comments below, hit the like button, subscribe here, add me on IG, and if you need help fixing your credit, we'd love to help you. Catch you in the next one.